Okay, here's why you're here today. You know there has to be something more than those boring free lunch dinners where somebody shows you how annuities work or life insurance works. You know there's got to be something more than making 5% in a whole year on your money. And you know there has to be something better than your 401k manager leaving your money in all the way to the bottom of a bear market crash and you taking several years to have to make that money back. Got to be more than that, right? Well, there is more. And if I do my job right, I think you're going to lose a little sleep over what I'm going to share with you today. Okay, so what if you're a little bit younger and you don't have a 401k yet, and you've got a little bit of money you're saving aside every time you get your paycheck? And so what could you do with that? Well, you might put that in a high yield savings account, or you could put some of it in a CD or something like that, or maybe even annuity. But you're going to make no more than 4.9%. Let's just round it off and say 5% with those options. And let me just say this. When some salesman tells you that an annuity is great because it's safe and they average 10% a year, well, let's just be nice about it. They're not accurate, okay? Because for one thing, annuities are sold to you from life insurance companies, and life insurance companies actually can go broke. If they go under, you lose all your money. It's not super likely, although in 2008, it almost happened. One of them actually did go broke and the government bailed them out. But do you think a government with trillions of dollars in debt like we are now would bail them out? We don't know, do we? So they're not completely safe, and they don't make 10% a year either. They don't average anywhere near that. And it might be a little startling to you, but had you put your money into one of the most popular index funds in 2022, which would have been the SPDR, which tracks the S&P, you would have actually lost 18.1% of your money. That's like 20% of your money gone, which is what they tell you to do. Just put it in an index fund and leave it. Buy it and hold it forever. You lost 20% of all the money you have in 2022. So with most of these things, you're looking at 5% in a whole year, as I said a few minutes ago. So think about that. Let's just do an example. Let's say you're starting out with $10,000. So you make $500 in a whole year. Now, how's that going to create wealth for you? Well, then they're going to come back and say, oh, but you have to count the fact that it compounds year over year over year your whole life. And by the time you compound all that interest, you're going to be ready to retire and you'll have a really comfortable retirement. Well, I think that's another reason you're here today, is that's not good with you. You're not here today to be comfortable. You're not okay with this new American dream of giving all of your infinitely valuable time to someone else your whole life and then just having a comfortable retirement. You want more than that for yourself and your family. What we really want to do is show you how to get your money off the unemployment line. We want to show you how to get your money making money. First strategy we usually teach at TRADEway is called a rolling stock strategy. I'm going to get into that in a minute, but we're going to compare that with what you might have grown up being taught. Even if you went through the MBA program, they would teach this. It's called the buy and hold method. Well, my favorite phrase for probably 2 decades is buy and hold is dead, okay? And really there's a place for it. So I'm saying it tongue in cheek. Okay, so these are shorter term stock strategies, and we're going to compare them to the things we talked about earlier, like bank CDs, things like that earn about 5% per year. And we'll see what the difference is. So first of all, let me give you a little preview of what we teach at TRADEway, because we take, most students come in there, they don't know anything. We start at the ground floor, okay? So here's something that we teach you're not going to see out there probably, and I call it the 3-leg table. And a 3-legged table looks like this. Let's say you put a pretty little 3-leg table in your house and you put some little pretty things on top of it. What would happen if you remove one of the 3 legs? Well, the whole thing falls, doesn't it? It crashes down. And that's the picture that I'm trying to make. And the 3 legs are fundamental analysis, technical analysis, and market tone. And, we're not going to go into all that today, but I just want you to know those are the things you look at. Fundamentals just means how well the company's doing. Good products, check. Good management, check. Good earnings per share, quarter to quarter, double digit, yeah. Okay, so that's fundamentals, right? How good is the company? Technicals, you're using a chart to see the cycles that the company makes, that their stock makes. And is there a good buy point and a good sell point that shows you? That's technical analysis. And market tone is looking at the news in the world and the economic news and seeing if that kind of saying, yeah, the market's happy, so let's do an up play. The market tone, though, you want to go and flow with it. If it's a happy market, then you want your stock trade to be something where you're buying something. You're buying a stock or a call option that makes money when the market goes up. And if the market's all gloomy and dark and bad news everywhere, you want to be doing something like buying puts or inverse ETFs, things that have potential to make money when the market goes down. How many ways does your neighbor think the market will go, right? He thinks it'll go up or down, but there's actually 3 ways. It can go up, down, or sideways. And interestingly enough, it's that sideways move that I'm going to share with you today. When you take these courses like TRADEway offers, a lot of times they're going to say, hey, if you try to buy options or if you do these things, you're just going to lose all your money. And the reason they're saying that is they're afraid and fearful and they don't know how it works. The first thing we want you to learn is when you win, we want you to win big. Okay. And when you lose, we want you to lose little. And we don't even call that a loss. We call it an expense, a business expense, right? It's psychological, but it's best. So I'll just give you an example. Like when your stock play goes up, you want it to go up at least 30%. When it doesn't go the way you want it to go, you don't want to lose more than about 8 to 10% at the most. So you can see there, you don't have to win, but a little bit more than 5 out of 10 times to make some money. And if you get that math on your side, but here's the thing, you got to keep the rules. And we have a set of rules for every strategy we teach. You got to keep the rules to get the math on your side. So win big, lose little. That seems simple, but if you're going to trade with emotions and all that, it won't work. You got to trade with rules. We're going to give you the rules. Secondly, we're going to teach you to leverage the big boys. So let me ask you this question. What if you had a way to tell when the big boys on Wall Street, and by that I mean fund managers, people that are managing billions and billions of dollars, if you could tell when they were going to get into a stock and or maybe they just got into a stock, what if you got in right after they did to the same stock? And then what if you could tell when they were about to get out of the stock and you got out before they got out? Could you make some money? Could that change your life? Well, that's what we're going to teach you how to do. Now, that's just a little preview of how that works. Now, the other thing a lot of people have trouble with is risk. In America, we're taught that risk is bad and we want to grow up, go to college, get a job, work for the government or whatever so that we have no risk. Well, there is no case where there's no risk. COVID showed that. A lot of government jobs were lost. A lot of regular jobs all over the world were lost. And so you can't say it's zero risk to have a job. But the main thing is God threw out into the universe this thing called the risk-return trade-off, right? It's there. And God expects us to learn skill sets and make what I call educated risks. How are we going to deal with this risk? Well, you have to manage it. Well, a simple way to manage that is to learn a little thing called stop losses, and we're going to teach you all about that. But that's where you lock in the small losses when the stock moves a direction you didn't think it was going to go, and it allows you to be okay with letting it go up 30 or 40% and taking profits when it goes the right direction. The other thing is to understand market tone. We're going to help you with that because that takes a few years to get where you're good at that. So we're going to provide that for you at TRADEway. I think at TRADEway, we have the best coaches in the world. We're going to hold your hand because I know when you first get started out, you're going to need that. Okay, so I'm going to show you an example of an actual trade. And this happened maybe 2 or 3 months ago, so it doesn't mean the trade would be perfect now with the same stock. So it's an academic example at this point. So here's the stock. It's DBX. That's Dropbox. That's probably a company that you know about. And so let's look at their stock. Well, here, if you look at this, you can see that this stock is kind of moving sideways. But when you learn how to draw support and resistance lines, which we'll teach you in TRADEway classes, of course, beginner classes, it really shows the roles. So here's what we call the support line. You can just pop it in like that, and you draw a line across where the bottoms are on the roll. Every time it goes down and starts back up, that's a point. And then another down and up, that's another point. Another down and up, that's 3. You need 3 points, and you connect them, and they always need to be horizontal lines for rolling stocks. So then you pop in a resistance line. That's a top line, and it's parallel to the bottom, and it hits most of the tops, okay? So you can see that stock rolls up and down between those lines, right? That's going to show us how to do this stock play in a minute. Buy and hold is certainly not up to date. But let's do one buy and hold because I want to make a comparison. So we're going to buy the stock here on August 3rd for $25.75. We're going to hold it the whole season here, which goes all the way out to November 21st. And you can see here we can sell it for about $28. So that's the buy and hold. Now, in real buy and hold, you might hold it 30 years, right? So we're going to just do this the same time frame that we want to do our rolling stock so we can have apples and apples. So pretend we just bought this and we were going to hold it and something happened, months later and we sold it. So that's a good example of a buy and hold play. All right, so here you can see our stock play and it shows the date we got in. We're going to assume that we're going to have about $30,000 in our account. Now, I want you to remember this. These same plays you can do with $10,000. You can do with $5,000. You can do with $500 in your account. So you just do the math. I like to do these where we can buy about 1,000 shares to make the math easy for these academic examples. Okay, so here we're going to probably not even use all $30,000 because 1,000 shares at 25.75 is $25,750. So that's the investment we're putting into this play. You can see here that we hold this for the entire time, and then on November 21st, we sell those same 1,000 shares, but they've gone up in value, so now they're worth $28. So they put $28,000 back in the account. We started with $25,750. Do the math and subtract those two, it'll give you the profit. So that's $2,250 profit, or an 8.74%. Okay, so with that example, we beat the other Wall Street boring products like annuities and CDs, and we did it in just 3 months. We beat their yearly ROI in 3 months, but it's not going to make you lose any sleep, is it? That's my job, so watch this. So here's what a rolling stock looks like academically, okay? See, this is a sideways move here. You're going to learn how to draw support and resistance lines, and they look like this. If you see the little dotted lines there, those are what I call buy and sell lines, because what I like to do is take the support and resistance lines that hit the actual tops and bottoms and then ooch the bottom line up a little and the top line down a little and trade within the trading lines rather than the other. It makes it more conservative. You'll actually catch more rolls that way. You say, well, is there a percentage you ooch it up? No, you just ooch it up, okay? A lot of you guys are analytical. I got a little bit of that in me, right? But you're going to have to turn on your artistic side to do really good charting. You got to see the picture, and that picture represents the probability math. That's what's so cool about it. The good news is, when you visualize that probability math, you don't have to crunch the numbers. And even if you can, and you guys over here that like to crunch the numbers, I'm going to try to get you to pull back from that, get a little bit more artistic, and learn to look at the picture. So your buy point, you're going to let it roll down, hit that support line, and bounce up. Your buy point is right when it bounces up. You want to get as close to that line as you can, but you want it to be moving up. Listen, your financial advisor will often tell you to buy stocks on the way down. They call that averaging down. Our family hasn't done that in 4 generations. We think it's stupid to buy a stock when it's going down because you don't know that it's going to come back just because your financial advisor says they always come back. No, they don't. So you want to let it bounce up off that support line, come down, hit it, bounce up. You buy it on the up bounce. That makes sense? So you let it keep going until it gets right before the resistance line and you sell it. So there is your sell point. You let the stock roll back down, which takes an average of about 2 weeks. It's 2 weeks up, 2 weeks down. On most of these great rolling stocks, that's what we look for. So 2 weeks go by and you just hold your money. Now you got more money though, because you just made some money. And when it bounces up again, you buy, and right before resistance, you sell, and you just keep doing that. Now think about that. So let's say it stops rolling in 3 months. We'll go find another stock right now today that's rolling, and maybe it rolls 3 months. If you only need 4 of those in a year, and then whatever that return is you make on that, you could just multiply that by 4, and that'd be your yearly return. And that number is probably going to be bigger than that 5% we talked about that you get with the bank CD. So let's ask this question, though. Is this strategy riskier? Well, I want you to think about this. You're actually only in the market half the time with this strategy. If you buy and hold, you're in it the whole time. Even when every time it's going down, you're still in it. How do you know it's going to bounce back up? That's an academic example. How do you know in real time? You don't know. So it's safer once it makes the roll up to sell, and take your money and just wait. So you're only in the play half the time. So why do people say that's riskier? It's actually twice as safe. This shows you the strategy pictorially. It shows you that you buy on the dips and you sell on strength, and you just keep doing that as it continues to roll all the way across there. And this one rolls for about 3 months. So this is the rolling stock strategy. Okay, so now here, I'm going to give you a hint. This is the place where you lose the sleep because I'm going to show you the money. All right, watch this. So you can see here that we buy this stock on August 3rd, 1,000 shares. Do the math, $25.75 times 1,000 is $25,750. So we don't even use all the $30,000 that's in our account. When it rolls up, It only takes 4 days, actually. On August the 7th, we sell those same 1,000 shares for $28.24. If you subtract what they put back in your account, which you can see there is $28,240 from the $25,750, there's your profit. So just watch this profit column. $2,490 is the profit you made on the first roll. What's interesting about that is it's really about the same you made on holding the whole thing when you buy and hold, and we only did one roll so far. So you can see what's about to happen is you're about to get what we call financial leverage, and you're going to get it in more than one way. Rather than just buying and holding it and making one buy and one sell, you're going to buy, sell, buy, sell, buy, sell, buy, sell. So that's multiplying it, isn't it? That's leverage. But also, since our first roll is over and we now have $2,490 more than we had, we can buy more shares the second roll. So that's leverage. I'm going to lose sleep tonight too. I can tell it already. August 18th, now we can buy 1,070 shares times 2630, roughly the same place where it comes back down and bounces up. It costs $28,141. We go out to September 1st and sell those 1,070 shares for $28. That is a $1,819 profit. Okay, it rolls back down, takes about 2 weeks. When it bounces up off support, we buy again on the 18th. But now we've got 1,135 shares. You see how we're leveraging? We can buy more shares because we made more money, and we made it faster. We buy this at $26.35, and it rolls back up after about 2 weeks on October 10th. We sell the 1,135 shares for $28, and that's another $1,873 profit. We do the roll one more time on the 8th and sell it on the 21st, and we make $2,573. Now, let's just add down that profit column. So now we've made $8,754. And that is not a 5% return. It's a 34% return, and it only took 3 months, which means you could go find 3 more because you got 4 quarters in a year. You could go do this 3 more times. So if you multiply that by 3 and assume you just found another stock that doesn't even have to be this one, a different one that rolls in a similar fashion, and you do those plays 3 more times, then that's what we call an annualized rate of 125%, 124.66. Let's round it up. 125% compared to 5%. So now you can lose some sleep, all right? 125% return. I mean, you've probably never seen that before. You think 5 or 8% is great in a whole year? You can see why I kept saying a whole year. Okay, now remember, this assumes that you find other rolling stocks 3 other times in a year, which is not difficult. But I mean, you do have to consider some of them may go wrong. Instead of bouncing up, they go down, you have to stop them out. So you're going to have some expenses. And if you keep your rules and do this well, you're going to do pretty well. I mean, what if you only did half that? 60%? That's not bad. I think that's a bit conservative, but 60% compared to 5, that's why you're here, right? Here's the results. Would you rather buy and hold and make $2,250 or 8.7% in this academic example? Or would you rather play all the rolls with half the risk, all other things equal, right? And make $8,754, which is, more like 34% return. Which would you rather do? Well, you just need to know the skill sets, and that's what we're going to help you with. So we just blew the bank CD 5% out of the water with our 34% return on the rolling stock. Well, next time, we're going to blow that out of the water, so don't miss it. And by the way, if you enjoyed this, check out the links in the description below, and we'll see you next time.